Welcome everyone to our Ask the Experts webinar today. We will begin the webcast in approximately 1 minute. Welcome everyone to our Ask the Experts webinar today. We appreciate each of you joining. We have a large crowd participating on the webcast and some compelling topics to discuss. My name is Bill Maloney. I'm an Executive Managing Director with Riveron. I'm joined by two of my colleagues, Drew Niehaus and Patrick Garrett, both Managing Directors with the firm. The three of us, along with some of our other colleagues, attended the annual AICPA Conference in December. It was a great 3-day event, and we are looking forward to sharing a number of the highlights from that conference with you today. Before we jump into the content today, a few key reminders. On our website, riveron.com, you can access all of our previous Ask the Experts webinars. There's a number of great accounting and reporting topics that are covered there. And perhaps most importantly, mark your calendars for Thursday, February 13th. We'll be hosting our next Ask the Experts webinar on that day. And we plan to host one of these webinars monthly during 2020 on a variety of relevant topics. During the webinar, we will include 4 polling questions today, which must be answered to be eligible for CPE. Also, we welcome your questions. There's a Q&A option in Zoom that you can use. Please feel free to do that. We'll try to get to the questions, but if we don't, we will respond separately. We've already received one question, and we will answer that one shortly. The webinar evaluation form and CPE certificate will be emailed to you within a week from today, following the webinar, along with access to the deck that we use today and our contact information. Please note that while the on-demand video will be available on our website, the on-demand is not eligible for CPE. So with that, let's get started with an overview of the conference, which will really act as a guide for the discussion today. As always, the conference speakers were primarily regulators and standard setters. They were discussing the top accounting, reporting, auditing, and regulatory developments. Conference attendees also heard about a number of emerging issues like blockchain. The conference mixed in a CFO panel and highlighted some of the day-to-day issues that CFOs are facing. We heard from a panel of preparers, investors, and analysts discussing best practices around the earnings release process. So quite a bit that was discussed with the overall emphasis and theme being to improve consistency and quality of financial reporting. As you look to the other theme section of this slide, the conference presenters really stressed the importance of auditor independence and engaging a strong audit committee in relation to independence. The SEC and PCAOB emphasized the importance of delineating between auditors and management and ensuring there's clear lines between those two in terms of the types of activities that each are engaging in. The SEC also highlighted some of their recent enforcement actions, and we expect the SEC and the PCAOB to remain vigilant on the enforcement side of independence. SEC rulemaking was another topic, and the changes there seem to stress both strengthening the capital markets while at the same time reducing the overall cost of compliance for companies. The SEC, perhaps not surprisingly, noted that they are continuing to spend significant time reviewing companies' disclosures around Brexit, the trade war, other events like the phase out of LIBOR, cybersecurity risks. So as always, the staff emphasized that they believe companies can continue to improve their disclosures. And then the presenters at the conference also highlighted the progress being made with the new PCAOB requirement for auditors to discuss critical audit matters, also known as CAMs. in the audit report. The requirement applies to large accelerated filers and was effective for fiscal years ending on or after June 30th of 2019. So a broad range of topics. We're going to talk in depth really on 4 of those today in this main theme section of this slide. We'll first discuss SEC comment letter trends, particularly as it relates to revenue recognition and MD&A. We'll also share some of the insights on non-GAAP disclosures, particularly the intersection of non-GAAP reporting and the adoption of the new standards. One of those new standards that's getting a lot of attention right now, or for some arguably not enough attention, is CECL, current expected credit losses. We'll share with you what was said at the conference on CECL. And then our final topic today is on the FASB agenda, and in particular, reference rate reform. The presenters at the conference spent a decent amount of time highlighting the anticipated challenges with LIBOR being phased out, and we'll talk about what the FASB is doing in that space and the accounting guidance that they're planning to issue in the near term. So with that, we will jump into our first polling question. The question says, on which topic have you had the most discussion with your auditors in the past quarter? A is auditor independence, B, critical audit matters or CAMs, C, current expected credit losses, CECL, D is reference rate reform, and E is revenue recognition. So if you please respond to that question. Patrick, while the participants are responding, one of the questions that I mentioned we received is on one of the topics that was discussed at the conference, SEC rulemaking, specifically amendments to Rule 305 and Article 11 around disclosure requirements for acquisitions and divestitures, and then specifically related to pro forma financial information. On that last point, pro forma information, can you share a little bit of insight in terms of what's changing there?
Yeah, as discussed at the conference, the changes to 305 and Article 11 are expected to be implemented or approved by the end of the year, and with that, the big changes in the pro forma space are really taking out the guidance that's currently in place on the pro formas and replacing that, the adjustments with 2 classes of adjustments. One related to transaction adjustments, and that's really to record purchase accounting impacts, really the accounting impacts of the transaction, so purchase accounting, transaction expenses, and the second category being management adjustments, which would allow companies to reflect synergies and the anticipated impacts of the transaction, really giving companies the ability to have more flexibility in providing more forward-looking information. Obviously, it can be more subjective and judgmental information there, and it'll be interesting to see how that gets applied, but those are the big changes coming there.
Great. Thanks, Patrick. Looking at the results from the polling question, clearly revenue recognition is getting the majority of the discussion right now. Drew, let's start with a discussion on SEC comment letter trends and some of the insights that were provided at the conference this year.
Sure. Thanks, Bill. Staff members in the Division of Corporation Finance spent some time during the conference discussing a few trending topics and comment letters to registrants this past year. This slide shows the top 10 areas subject to comment by the SEC in 2019, and on the right you can see the relative change from the prior year. So taking a look at the listing holistically, the content is relatively consistent with years past in terms of the topics. We did see segment reporting after climbing up the list in recent years took a dip, while revenue ended up as the most frequently addressed topic, which is probably not a surprise. Moving on, and I guess focusing on that revenue, when discussing revenue disclosures at the conference, the staff noted that there were a wide range of disclosures in this first full calendar year under the new standard. Let's take a deeper look into some of the themes where the staff had comments in the revenue disclosures in the first year. First, there was a lot of discussion surrounding the determination of performance obligations. Frequently, the comment from the staff focused on situations where a company performed a number of activities under one contract, but ended up concluding that they had only 1 or 2 performance obligations. Specifically in those instances, we saw the staff questioning how those companies supported their conclusion that the goods and services were not separately identifiable or distinct, to use the parlance of the new standard. Given the importance of the determination of performance obligations on the implementation of the new standard, there were several other areas of inquiry, including the nature of the performance obligations, which is a required disclosure, and disclosure of remaining performance obligations. Another common area of comment was the conclusion as to whether the company is acting as the principal or an agent in a transaction. Questions around the judgments related to the gross versus net presentation of revenue were common. Often, the staff requested further information on the company's assessment of whether the company controlled goods or services being provided. So you're seeing a theme here in terms where judgment is included in the company's conclusions. The staff is asking for a little more information on how the company made those judgments and what the rationale and support was. Although not related to the comment letter process specifically, I did think it was interesting that during the update from the Office of the Chief Accountant, they noted that as it relates to revenue recognition, the determination of performance obligations and the conclusion on principal versus agent were the top two areas of consult where companies were asking for guidance over the course of 2019. Again, given the judgment involved in those conclusions, it's probably not surprising that these are also two common areas where the staff is asking for further clarification and disclosures. Finally, as it relates to multiple of the bullet points on this slide, the staff frequently will compare information in one area of the document or even outside of the document to information in other areas and ask clarifying questions. For example, although many companies align their disaggregated revenue disclosures with their reportable segments, the staff would call into question through a comment how the company considered other information presented within things such as, say, investor presentations, where you might see sales by geography, customer type, or other sorts of breakdowns, and how the company would consider that within their disaggregated revenue recognition disclosure. Moving on from revenue recognition, let's focus a little bit on the MD&A. The MD&A continues to be a popular area for comment. During the conference, the Division of Corporation Finance focused on a few specific topics within the MD&A. First, there's been an increase recently in the use of supplier finance programs.
So Drew, then on that point specifically, can you just provide a quick overview on what you mean by supplier finance programs?
Sure. These programs are also known as structured trade payables and involve a third party, typically a bank or a financial institution, settling amounts owed to a company's suppliers, the company's accounts payable. Separately, the company will then settle with the bank. There are many types of structures of these agreements, but often the impact, I'd say the most common impact, involves extended payment terms, which has the result of improving a company's cash flows over that term. Despite the increase in use of these programs, companies are not always disclosing the impacts on liquidity in the MD&A, even if material. So that's kind of why this is getting more play and what the staff discussed during the conference. The staff suggested that if the effects of the program are expected to be material, the company should consider disclosing the details of the program, things like key terms, plans to further extend payment terms, and any factors that may prevent the company from using this type of arrangement in the future. So think of it like this. If you put a structured financing program in place and you use it for 1 year or 2 years, but do not anticipate to use it in the future, that will cause inconsistency within your cash flow information period over period. So a company's intent to continue to use or no longer use these programs is something that should be disclosed to the extent it has a material impact on the cash flows within the MD&A. Beyond structured trade payables, the staff discussed more current events and their expectation of disclosure within the MD&A. While they recognize that the impact of upcoming events such as Brexit and reference rate reform, which we'll talk about later, is something companies should disclose, they caution that you should only do this if it's material and relevant to the company. You'll hear this as a theme throughout the presentation, that the staff would prefer to avoid reading boilerplate disclosures that don't provide relevant information. As a guide for how much and what companies should disclose regarding events such as these, companies should look to communication with their boards to inform the content of the MD&A disclosures. Beyond some of these more trending topics that I've discussed, other areas of comment related as it relates to the MD&A are fairly consistent with a couple past years. Specifically, as it relates to critical accounting estimates and judgments made in the application of significant accounting policies, the staff will ask about the likelihood of different results if assumptions made do not end up proving to be true. So as an example, you have specific judgments going into your goodwill impairment evaluations, such as discount rates. The change in the discount rate could have a significant impact on the conclusion as to whether or not your goodwill is impaired. So the staff would say that to the extent appropriate and material, there should be discussion around to what extent changes in that discount rate would result in changes in the overall accounting conclusion. Beyond the content of the letters, of the SEC comment letters, one of my favorite sections of the conference is the panel covering best practices in responding to comment letters, since they provide tips and practical advice. Oftentimes, companies and registrants' accounting departments are responding directly to staff comment letters for the first time, so this section kind of provides real-life guidance that companies can use. For example, calling the staff for clarification can save a registrant a lot of time and effort. That said, when reaching out, companies should make sure they're prepared, provide background, the facts, and make sure that any analysis they communicate has been researched and supported to help facilitate this discussion. Basically, don't assume that when you pick up the phone and someone answers on the other end, they know everything about the question you're about to ask. Often, it can be helpful to review other filings of similar circumstances to get a sense of whether or not there is diversity in practice regarding the topic of concern. However, don't assume that a filing without a comment letter sets a precedent that you can replicate. The filing may not have been reviewed by the staff.
So Drew, maybe we pause there. You mentioned a scenario where maybe the filing hasn't been reviewed by the staff, but let's say you have another company that you're looking at in similar situation, but in that case, the filing has been reviewed by the staff and has been subject to their review. What level of reliance can a company place there in that type of situation?
It's a good question. And while it is a good practice to review other companies' filings to understand the diversity in practice, even if you find a filing that was reviewed by the staff and you can review the comment letter process going back and forth, clearing the comment letter process is not the same as the staff concurring with the disclosure. For example, a filing may have been reviewed, but the disclosure in question was not a focus area, or perhaps it was considered immaterial. Overall, again, the takeaway is that while reviewing what else is out there can be helpful, do not stake your argument on other filings as precedent. Spend time clearly articulating your rationale, the support, and your conclusions, which is a good segue for the next tip. Address concerns about materiality early. If you believe that a comment is related to a matter that is immaterial to your company, concluding on that upfront will ensure both your resources and the staff spend their time most efficiently on the most impactful items. Said differently, it doesn't make a lot of sense to go back and forth in 5 iterations of a comment letter on a topic only to find out on the 6th iteration that its material, the staff concurs or does not object to your materiality conclusion, and you could have saved a lot of time and effort up front.
Okay, thanks very much, Jerry, appreciate that. We are now at polling question 2, which reads, which of these disclosures do you anticipate will be the most challenging in your upcoming year-end reporting? A is segment reporting, B, revenue recognition, C, goodwill, and D, income taxes. So please go ahead and submit your responses while we wait for our participants to respond. Drew, you talked about the comment letter process and specifically revenue recognition. What about leases? Any insights that you can share with our audience there?
Sure, it's a good question. Even though it wasn't on the list of comment letter trends, the staff mentioned that they are in the early stages of reviewing leasing disclosures, and they did provide a couple quick reminders for registrants putting together information for the first time under ASC 842. First, the staff reminded registrants that the new disclosure requirements are meant to enable users of the financial statements to have information on the timing and uncertainty of cash flows arising from leases. Reviewing the updated requirements under 842, make sure you review the updated requirements under 842, as you won't be able to roll your previous disclosures forward, or frankly, much of the content from your previous disclosures forward, given the focus on that timing and uncertainty of cash flows in the new standard. Second, the staff stressed the fact that you should tailor your descriptions to your specific lease agreements. That should be obvious, but again, avoid boilerplate disclosure. The staff mentioned lesson learned from reviewing SEC disclosures related to revenue recognition is that they found oftentimes companies would repeat disclosure from other companies or provide generic boilerplate disclosures. So make sure that you're tailoring your disclosure to your specific lease agreements. Relatively simple reminders, Bill, but I think that the staff has seen a wide variety of revenue disclosures and wanted to address a couple of the more straightforward issues.
Yeah, very good. Thank you for that. The polling results are in, and revenue recognition, again, at the top here, taking more than 50% in terms of what folks believe is going to be most challenging in the upcoming year in reporting around disclosure. So we'll move on. Drew, as we continue on the topic of non-GAAP information, continues to be in the crosshairs for the SEC, and the topic received a fair amount of attention at the conference.
That's right. The topic has been at the forefront of this conference the past few years. A discussion of non-GAAP measures seems to be included in nearly every speech or panel throughout the conference. Starting right at the beginning with comments from SEC Chairman Clayton, non-GAAP measures were discussed throughout the SEC enforcement update, the comment letter panel, the Division of Corporation Finance update, and honestly, most others. Just as a quick refresher, let's talk about what we mean when we say non-GAAP measures. Generally, these are GAAP measures that have been adjusted to include or exclude specific items. Common examples are adjusted EBITDA, adjusted EPS, and certain margin disclosures. And as you can see on the slide, when we talk about supplemental information, that means communication of financial results and measures that is outside of the GAAP financial statements. Said differently, supplemental information is where non-GAAP measures are reported.
So, Drew, it's worth a question here, I think. I know that I've heard the question in practice and be worth us discussing just a little bit. The SEC has focused on non-GAAP for a number of years now. This is not new this year. So why does it, in your mind, continue to receive so much attention?
It's a fair question. As the conference continued on, we were able to get a good sense of why this continues to be a trending topic. Simply put, company stakeholders, including investors and analysts, rely on this information to make decisions, and I think rely on it to an increasing amount every year. If the non-GAAP measures being disclosed are the right ones, they should be the measures the company itself is using to make key decisions about the business, in addition to the GAAP financial information, of course. And I want to focus on that point for a second. Chairman Clayton stressed that there should not be two sets of measures, one solely for investors and one for management. If a company discloses non-GAAP information, it should be the same information the company itself uses internally. Another reason that it continues to receive increasing attention is that the form of these measures continues to evolve. So as we see things that are common, such as the adjusted measures I mentioned before, we also see new things that I'll talk about a bit later, such as tailored accounting principles. As new measures creep up, the SEC's focus on these new measures obviously will continue to increase. One of the panels I found particularly interesting this year was the panel focused on the perspective of stakeholders and investors. This included equity researchers and analysts who gave their thoughts on non-GAAP measures. So when asked about information outside the GAAP financials and how they use it, the analysts responded that this supplemental information, things like earnings releases, investor presentations, 8K filings, is often the most useful information when making investing decisions, which, so those of us on the line right now probably may come as a shock or, may take offense to, considering the time and effort spent on GAAP financial information. But they explain two reasons for this. Practically, these items are typically available earlier than interim or annual GAAP financial statements. And beyond that, as I mentioned before, understanding what is important to management or the items management is excluding from their results provides a line of sight into a company's thinking about how a business is run, which can be useful to company stakeholders. I also want to highlight that the analysts and researchers on this panel talked a bit about the quality of this non-GAAP information. Basically, in order for this information to be useful, they said they expect two things. One, consistency, that the same metrics are provided each quarter, calculated the same way. And two, that there is a reconciliation back to the GAAP numbers, which is a reporting requirement. Without this, they mentioned, it's difficult for them to put the non-GAAP number into the right context. So those two concepts, consistency and reconciliation back to GAAP measures, are two areas that we see pop up again and again in SEC comment letters. Consistency in particular is a repeated message. If a non-GAAP calculation changes quarter over quarter, you lose that comparability. It's important that investors know adjustments are rare and that when they happen, they are clearly reported. In addition to those areas, at the conference this year, there was more discussion around how the newly issued accounting standards play into non-GAAP measures. For example, the staff commented that it would generally not be appropriate to disclose measures that reflect legacy accounting for revenue after the ASC 606 transition disclosures are no longer required. Said differently, suggesting that 605 revenue is a metric that the company uses to manage their business 2 years after adoption doesn't make much sense to the staff. Along those same lines, the staff also mentioned that it would not be appropriate for companies that adopt ASC 326 or CECL to disclose a non-GAAP measure excluding the impact of the new standard. Beyond the new standards, contribution margin and similar measures were also discussed. These measures are considered to be non-GAAP. When thinking about reconciling these, as I mentioned earlier, which is one, a requirement, and two, something that stakeholders view as useful, the gross margin is likely to be the most directly comparable GAAP measure. So even if gross margin can't be calculated from amounts on the face of the P&L, if you are presenting contribution margin, you'd have to provide gross margin as a baseline and then reconcile back to that number. Finally, as I mentioned earlier, I want to quickly mention the concept of individually tailored accounting principles. This is a fairly new concept in non-GAAP reporting within the last few years. Essentially, individually tailored disclosures are where a company provides a non-GAAP measure by altering the underlying accounting to the GAAP measure. The staff has indicated that these may be inappropriate, and it's a concept that has come up in the past couple years at the conference. Since this is a bit of a nuanced concept, let me provide an example. Let's say a company has concluded it is the agent under ASC 606 and reports net revenue in the GAAP financial statements. What if the company wants to present non-GAAP revenue measure in its earnings release showing revenue on a gross basis? This gross presentation would be an example of where a company has tailored an accounting principle. Under GAAP, they are considering themselves an agent. The company then tailors that accounting principle and discloses revenue as if they were the principal. As mentioned, there's a high likelihood that the staff may not find this measure appropriate. Since tailoring accounting principles for non-GAAP disclosure is something that staff will probably question, it's important to understand this concept, especially as those disclosures are becoming more prevalent.
Very good. Thanks, Drew. That brings us to our third polling question. Of the new standards, which has been the most challenging to explain the impact to stakeholders? A, revenue recognition, B, leases, and C, CECL. So we'll give the audience a minute here to weigh in on that question.
Bill, as people are answering this, I wanted to take a minute to talk about a topic unrelated to non-GAAP measures and quickly mention the discussion of cybersecurity in the conference, as I think it's probably a topic that is getting more relevant to companies every year. Frankly, at the conference, it was a topic that was touched on lightly, but there was a discussion about whether auditors are expected to provide assurance over cybersecurity risks and how they should rely on the companies they're auditing. The PCAOB specifically discussed this point, essentially saying that cybersecurity is like any other risk. Companies should manage and monitor that risk. Basically, the threat of a cybersecurity breach should be incorporated into the control framework, kind of like contingencies or litigation risks. And of course, the same disclosure considerations apply to cybersecurity risks just as they apply to any of those other types of risks. In terms of what we can expect, in terms of whether we can expect any new significant guidance on this topic, the standard setting bodies didn't really touch on this, and the PCAOB frankly punted on it a bit, basically saying that their mandate comes from Congress, and if Congress changes the focus on this topic, then so will they.
Very good. So the polling results are in. Looks like leases took the top spot here, just barely. Along with revenue recognition, the two of those certainly make up the lion's share here in terms of working to explain that impact to stakeholders, which is a very, very important piece. So, Patrick, we've heard quite a bit about the adoption of revenue recognition and leases, so turning our attention to the latest major standard that needs to be adopted, or that is being adopted, which is CECL. Can you share with us just a bit about what we heard at the conference on this topic?
Sure, Bill, yeah. You know, at the conference, similar to what we saw with RevRec and leases, there was not a lot of pointed technical discussion about CECL and the implementation of ASC 326. You know, we would expect, and consistent with that pattern, you know, we'll see that as preparers, you know, go through this reporting season and the SEC begins to see what issues they run into. However, they did touch on, you know, what's available currently, kind of the current state of implementation, you know, noting the delay for smaller reporting companies, pushing that back to 2023 before they'll have to adopt the standard. They also touched on, and this is probably key as you come into your 10K season, Stat 74 disclosures. You know, similar to ASC 842. I think there's an expectation that these disclosures will be fairly detailed, providing good qualitative and quantitative information regarding the adoption of CECL. You know, and then the staff also noted that, you know, consistent with Drew's point about non-GAAP, that CECL should not be included as a non-GAAP adjustment. You know, continuing to make sure that that's calling that out specifically is not an appropriate non-GAAP adjustment. You know, and the FASB also noted that they are continuing to, one of their priorities is to continue with the assisting with implementation of the standard, reiterating their establishment of the Transition Resources Group. This Transition Resources Group is similar to what we saw with ASC 606. They're addressing questions that preparers have as they come in. They've not been quite as robust in terms of producing, you know, the kinds of memos and position papers that the 606 group had, but they do have several Q&As out there, and they are responding to several inquiries and able to address specific topics that preparers have sent in inquiries and questions about.
So Patrick, you know, speaking about the TRG and folks being able to use that as a resource, and I know you're getting ready to share a little bit around implementation tips. Maybe you can, before doing that, just talk to us just a little bit about the level of effort that we're seeing, as it relates to implementing this standard. What are we seeing around the level of effort for companies?
So in our discussions with a lot of our clients and companies that we work with, they're indicating that it's a lot more challenging than they expected in terms of thinking through how to apply the nuances of the guidance, in particular around companies that may only have trade receivables or may have certain specific one-off situations. The FASB or the SEC pointed out that they've issued SAP 119, which lists out several considerations around the documentation that they would expect for companies to have and consider around process, a systematic and rationale approach and methodology, and the governance around the standard. They've also pointed out, they get a lot of questions about how do I apply this to a company that may only have trade receivables with using an aging schedule to calculate their allowance. And they pointed out that there is an example in the implementation guidance within the standard that specifically addresses that. And the key thing that you note if you go look at that example is that it really does point towards not only the historical data that's available, but also the impact of the forecasted data that needs to be taken into account. And in our discussions with companies, one of the things that we've emphasized and talked through is where you see an aging schedule and where companies may not have an allowance in the current bucket, they may assess that as receiving no allowance, that they may need to go back and really carefully consider that. And whether that's appropriate, once you take into account the forecast and what the truly expected losses. One consultation that the Office of the Chief Accountant did note was regarding a lender that had made advances on behalf of a borrower. And in this scenario, the question was, do they take those into account in determining their current expected credit losses allowance? And the staff, and through those deliberations, they came to the conclusion that those advances would not meet the definition of the cost and really wouldn't be included in those cash flows. And I think this just highlights that where you have one-off or unusual type situations, there's a lot of judgment that needs to be applied as you implement the new standard here.
Great, thanks, Patrick. Appreciate that. Our final topic today is the FASB agenda, and specifically the heavy focus on reference rate reform. So, Patrick, can you take us through that as well?
Sure. One thing I wanted to kind of set the stage here, and on the slide here, you'll see there's kind of a timeline around, this transition from LIBOR to SOFR. And I think it's helpful to have a little bit of context around, why LIBOR is changing and, where that originated and kind of where we are in this timeline. And it really something that came out of the 2008 financial crisis, where companies started, regulators, every kind of took a step back and said, the process around LIBOR is somewhat antiquated. It's a little bit outdated, and so they said, should we, begin to look for a replacement for that? LIBOR being a very judgmental kind of base reference rate, and so most significant markets established their own committee and working groups to select a new benchmark rate to replace LIBOR. That was in that 2012, 2014 timeframe. The U.S. committee was the Alternative Reference Rates Committee, and it published a report in the beginning of 2017 that indicated recommended SOFR as a LIBOR alternative. In April of 2017, the NY Fed began publishing the SOFR rate daily. And the big difference between SOFR and LIBOR, and I won't go into too much of detail on that, but being that the SOFR rate is more based on transactional data from the U.S. Treasury repurchase market. So it's a much more data-driven reference rate versus the LIBOR, which is a little bit more judgmental and set up by the panel of banks. That brings us to more current day, where the FASB started to consider what the impact of that change from LIBOR would be, in terms of what contracts are out there that may have an impact, and issued an exposure draft in September 2019. And in the conference, they committed to, they indicated that they received comments and are nearing finishing their redeliberations and issuing the final guidance expected by March 2020. And then you'll see in the timeline that LIBOR is expected to be phased out by 2021, by the end of 2021. And one interesting thing to note here is the guidance that the FASB is expected to issue will expire in January of 2023. So this is a new, it's the first time that the FASB's actually issued guidance that will expire. So we're in a history-making time in the world of standard setting. And it's really reflects a pragmatic approach to the reference rate reform in terms of wanting to provide relief from the burden of having to analyze the company's contracts, but also not wanting to implement something that may be expanded and applied where it was not intended to be applied for normal kinds of contract modifications. So going into the next slide, really the areas that are impacted by LIBOR are probably the ones that, and how it would impact financial reporting and accounting. Really the ones that probably jump out at you is the derivatives and hedges, loans, and wherever discount rates are applied. In the derivatives and hedges where you have interest rate derivatives and cash flow hedges, they can have a significant impact from a modification of terms and changing from the LIBOR to the new interest rate. Loans, the question being really, would you have to evaluate every loan that changes from LIBOR or a LIBOR reference rate to SOFR for modification or extinguishment accounting? And then discount rates, where you would see LIBOR used as a basis for some valuation models. How would that be impacted? And then, where leases might also have a reference rate indexed to LIBOR, that could have a significant impact as far as needing to assess whether that lease was modified. So those are the bigger areas of LIBOR impact. And the exposure draft issued by the FASB really seeks to address those areas head on. It's called out in that contracts that are in scope of ASC 310 related to receivables and loans, ASC 470 related to debt, ASC 842 leases, and ASC 815 hedging and derivatives. Calling those out specifically as being in scope of the reference rate reform and relief guidance, really with the objective of saying there would be no modification for your debt transactions. You would ignore, if the only thing that changes is the rate, then you would not apply the modification or extinguishment. Similar kind of guidance for 842. On the 815 side, there would be no need to go back and reassess whether there was an embedded derivative that should be bifurcated, which I know is a big relief for most preparers, as well as the FASB and the SEC also clarified that they would not, or that they would consider that preparers should, where there are interest rate transactions under derivative arrangements, that just because they are indexed currently to LIBOR and they go past 2021, you would still consider those transactions probable, even though LIBOR is going to cease being issued as a reference rate after 2021 for your current accounting, and then you would deal with the transition prospectively. And then going on to the rest of the FASB agenda. The Russ Golden, it's the end of the golden era, so to speak. He has been the FASB chair for 12 years, and he'll be replaced in this coming June by Rich Jones, currently the chief accountant at DY. But he indicated that, he laid out the priorities for the remainder of the near term for the FASB and the remainder of his term as chairman. Reference rate reform being the top priority, and as previously discussed. Debt versus equity is another priority that he indicated that they would issue the final guidance before the end of his term as chairman. Really there, the exposure draft indicated, the bigger changes around a simplification of the models for accounting for convertible debt, as well as simplification and changes to the derivative scope exception so that it's not as restrictive in its application. He also, those were the two bigger ones that he mentioned that would be key and finished during his term. But he also indicated that after his term was over, the FASB would continue on with the Goodwill project. A lot of questions about the future of goodwill and accounting for goodwill and how it should be treated. That will continue to be going forward, but it's certainly on the FASB's front burner. And then performance reporting and segment disclosures. The FASB has added a project to their agenda to discuss performance reporting and really focusing on the disaggregation of performance information, whether that's in the financial statements themselves or in the footnotes. And this is really a topic that the FASB is just beginning to explore and take comments on, et cetera. So along with that, the other near-term priority for the FASB is the implementation of new standards and continuing to assist preparers with revenue releases, CECL, et cetera.
Very good. Thanks, Patrick. Good discussion there. That brings us to our fourth and final polling question, which says, which of the topics on the future FASB agenda are you interested in learning more about? A, reference rate reform, B, goodwill, C, debt versus equity, and D, performance reporting. So please take a minute to go ahead and respond to those.
Yeah, Bill, one thing I'd like to remind everybody about is just that the SEC speeches, so the staff, from the Office of the Chief Accountant and Division of Corporate Finance, they give you several speeches that have a lot of pointed technical information and clarifications at this conference, and all of those speeches are available online on the SEC's website. There's this section under speeches, so they had a lot of very pointed situational speeches and guidance that they gave this year. Some examples around the intersection between sale leasebacks and revenue recognition under ASC 606, some clarification of determining the primary beneficiary under VIEs, et cetera. So there's some good information, and if you have some real nuanced accounting issues, that's a good resource that you can utilize.
Very good. Thanks, Patrick. Poll results are in. Performance reporting and debt versus equity right at the top there. Performance reporting, is tops, but some good topics there, and we'll look to perhaps address those on future webinars as well here. Before we close things up, one question that we do have that we want to cover on the questions that came in. Drew, do you want to take us through one of the questions?
Yep, sure. We got a question on whether there were any updates provided by the PCAOB in the conference, which is fair given that the PCAOB is in the title of this mouthful of a title of conference. And it's also probably a good thing to note because, well, they're not directly regulating registrants. Companies definitely feel the impact of new audit standards and inspection trends, things like that. So I think we've touched on CAMs a little bit, and the new critical audit matter disclosure within the audit opinions did get a fair amount of attention. Beyond that, it seems like an inflection point for the PCAOB in terms of where they are and where they're headed. So there were a lot of things that the PCAOB acknowledged that they're going to try to do better and address in the future. Specifically, one thing that they mentioned was that it's an issue that companies and preparers don't know how to engage with the PCAOB. Auditors typically have that relationship, but as I mentioned, preparers themselves often feel a lot of the impact of what PCAOB is doing. So to begin to address this, the PCAOB has created a new office, the Office of External Affairs, which is focused on gathering feedback from audit committees, preparers, and companies, and even investors and analysts. The other focus area for the PCAOB was trying to look at preventative measures rather than rely heavily so much on the inspection process, which can be long, judgmental, and sometimes contentious. So the PCAOB will be taking a harder look at the quality controls at the audit firms themselves. In theory, better controls in place at audit firms, the better the audits and the less the PCAOB has to rely on the inspection. So those were a couple things discussed related specifically to the PCAOB.
Super. Thanks, Drew. In closing, final slide here, I want to highlight for you just some of our thought leadership on the topics we discussed today. If you use them as reference, you'll find all of these on our website, the conference recap report, some further insights on the SEC comment letter process, revenue recognition, non-GAAP financial measures, CECL's impact on short-term receivables, which basically is something every company will need to address, and then finally how to prepare for the LIBOR transition. We really appreciate everyone joining. Once again, our next webinar is on February 13th, and we look forward to meeting with you again then. Enjoy the rest of your day.